Thank you for joining our live chat. I'm Farron Powell, the Paying for College reporter here at US News and World Report. And I'm joined by Susanna Snyder, our personal finance editor. Today, we're discussing a topic that's essential to any parent with a college-bound student. Oftentimes, even with financial aid, many families often face a tuition gap. And borrowing loans is one way to bridge that gap. So we're here today to discuss what you need to know when it comes to borrowing for college.
All right, and we have two fantastic guests today. Our first is Pete Wiley. He is Vice President of In-School Lending at Common Bond, which offers private loan and refinancing services to students and parents. And our second is Shannon Vasconcelos. She's Director of College Finance at College Coach, a company that provides admissions assistance. So these experts are going to demystify the process behind borrowing federal loans, private loans, or finding another source to fund your child's college education. And they'll help you do that all without risking your own retirement. So let's get started. This first question is for you, Shannon. And it is, what are the loan options for parents who want to borrow?
Well, actually, the first option that you probably want to tap is not for parents to borrow, but for students to borrow, called the Federal Direct Stafford Loan Program. You'll also see it referred to as the Direct Subsidized and Unsubsidized Loan. They're talking about the same program here. That's a loan in the student's name, very automatic. As long as you fill out the FAFSA, every student can borrow this loan. Decent interest rate, borrower protections built in. It's from the federal government. The sort of catch with the Stafford loans is that they're capped at fairly small amounts, ranging from $5,500 to $7,500 per year. So you're not going to finance your entire education that way, except maybe at a community college. If you need to borrow more than that $5,500 to $7,500, that's when parents have to be involved. There's another federal government loan program called the PLUS loan that is for parents to borrow. It's totally in the parent's name. Again, nice federal protections built in, not quite as automatic as the Staffords. You do have to pass a credit check. And the interest rate is fixed at 7%. Now, if you don't like the sound of that interest rate, you can shop around. Some states have alternative loan programs that you could take a look at. Private lenders offer education loans, whether it's a traditional brick and mortar bank, credit union, or an online lender like Pete's. And then some parents will stay out of the education loan market altogether and will tap their home equity and use a home equity loan instead. That can likely get you a pretty low fixed interest rate, but you do have to acknowledge you're putting your house up as collateral. So there's some risk there. So most people take advantage of the Stafford loans first, and then it's shopping around between the PLUS loan, state loan, private education loan, or home equity. Those are the basic options.
The next question is for Pete. So when you're shopping around for loans, what do parents need to know about interest rates when it comes to these education loans?
Yeah, sure thing. And first of all, thanks for having me. When it comes to a rate of interest, that is the amount of interest that will accrue every day on the amount that's outstanding. So it's really the price that you're paying for the amount of loans that you've borrowed. Most loans charge that, based on the rate that you see, divided by 365. So that's an easy way for someone to understand each thing for the amount that they've borrowed. What is really important as well is for somebody to consider the APR also, which includes fees that are associated above and beyond the interest rate. So that's just something that's important. In the PLUS loan program, for instance, through the federal government, there is a large origination fee that is added to the amount that's dispersed to the parent. And then that larger balance then starts accruing interest at the listed rate. So just one thing to keep in mind as parents are out there shopping for their options, but the interest rate's really important and helps people compare the price that they'll pay for the amount that they're borrowing.
And just a quick follow-up, what should parents know about some of the differences, even looking at private loans, when it comes to variable interest rates and fixed interest rates?
Question, and there are products in the market in both categories. Let's start with fixed rate. So a fixed rate loan bears that rate of interest the day that you sign the papers, the day that you disperse the loan, and it won't change over the lifetime of the loan until you repay the total principal balance. In variable rate loans, the mechanics can differ from lender to lender, but most of them reset on a monthly basis based on the current interest rates. And if you've been following the news over the past several months, we're in an environment where rates are starting to climb. And what that means is that each month, the rate of interest that's getting charged to the borrower will increase along with those rates. So that's something to really keep in mind when you're thinking about a 5, 7, 10, or even 20-year commitment. That rate can change and can be different in the future in a variable product.
And I just want to follow up over to Shannon before we move on to our next question on this topic of interest rates. What should parents know when it comes to interest rates when it's with a federal loan in terms of parent borrowing?
Right, so that's one of sort of nice protection built into the federal loans, that they're always, at least under current legislation, they're fixed interest rates. The direct Stafford loan program, currently the interest rate is 4.45. Those are the loans that students can borrow. And then the PLUS loan, the parents can borrow, the rate is currently 7%. Those rates are reset annually. July 1st of each year, new interest rates for loans for the upcoming school year kick in. So we don't know exactly what those are going to be yet for the upcoming school year. But with the federal loans, they're always fixed rate loans. So that, again, it's a little less risky that way than a variable rate loan.
All right, thank you. Those are great points and a great way to kind of differentiate between two different kinds of interest rate styles. So this next question is actually back to you, Shannon. And it is, how do parents plan to borrow for all 4 years of college? I think this is sometimes a tough thing to get their heads around. So how can they do that?
It's so hard to get your head around. I talk to so many families and they're just worried about getting that first bill paid or getting through that first year. But that's the biggest thing that parents really need to think about, that college is at least a 4-year commitment. So you want to make sure that you're preparing for all 4 years. If you figure out, I need to borrow $20,000 to pay for a freshman year, you want to run a loan repayment calculator. You can find them all over the web. Bankrate has one. There's lots of great loan repayment calculators out there. So on a $20,000 loan, that might result in monthly payments for $200, $250, somewhere in that ballpark for the next 10 years. But remember, that's only year one. So maybe you can afford $250 a month. But by the time you get through 4 years, if your financial circumstances stay about the same, you're looking at $1,000 monthly payments. That's a much different story. So you want to make sure that you're thinking about that up front and preparing for that, and not enroll. You're not prepared those bills after 4 years. The other thing to think about is your financial aid going to stay the same for all 4 years? If things stay the same in your financial circumstances, it probably will. But do you have, 2 kids in college and one's going to graduate? That can change the financial aid picture. If you get a different job, that's going to change the picture. So those are conversations you might want to have with the financial aid office to be able to project your 4-year costs. So those are the things you want to think about. The other thing I would recommend before you look at loans at all, check out the college's monthly payment plan. If you can figure out how you can budget some of your paycheck on a monthly basis to pay the bill that way, to minimize the amount you have to borrow, I think that's key.
Yeah, and Shannon, I'd love to say just one more word there. I think if I could leave the parents on the line with one thing today, it's just recognizing that gaps, when they occur, you can't go back and change the way you paid for the freshman year in your junior year. And what I see sometimes is parents who have a decent amount of savings at the outset of maybe their first child's education, especially if they have multiple children, often will exhaust that up front. And what that creates is the inability for a child to have used that Stafford loan in a freshman year because it was capped. And so, really look at that full cycle and full lifetime that you're going to have to fund. And in that first and second year, the Stafford product is at such a low interest rate and has really generous repayment protections. It can be a really nice tool to use, even if you have savings available. And I know that can be a bit counterintuitive, but it's a really important point just to grasp, is that the federal government caps what you can borrow at that extremely low interest rate per year of study. And so you can't go back in time to get access to it. And so that's just one that I've learned, and in multiple conversations with my own family members, tried to always, bring to the surface, because it's not clear and well understood.
Well, that's great advice. And actually, back to you, Pete. I mean, are there any other strategies families can use to kind of make this plan for all 4 years? Any way else that they can kind of achieve having that long-term view when they're...
I thought Shannon had great advice there. Really just educate yourself up front. Another one that's important to note is the selection of the school itself. Really think about the total cost and commitment that you're making for 4 years. Think about who's going to play a role in funding it. The student has an obligation, the parent has. You have to make that choice together as a family. And, it really sometimes is difficult to know what your circumstances are going to be in 2 years and in 3 years. And I think another thing I've seen happen is just projecting like nothing's going to change into the future. And we all know it's unpredictable in life. And so be conservative in those projections. Really think about your options and be, really thoughtful about where you think you're going to be. And Shannon makes a great point too, that 60% of people who attend college don't finish in 4 years. Anticipate that 5th year, anticipate additional semesters of study. And that's something that isn't elevated enough in this conversation.
This next question is for Pete, for you again. When should your student have some skin in the game? When should they take on the loan? How much, when do you know when a parent should take the loan, when should the student?
Again, that's going to come down to each family's decision, is the first thing I'd like to start with there. And everyone's going to have their personal view around the level of responsibility that should be shared. But starting with that, again, the student in their name has access to the best and least cost product the federal government offers. That's the first thing that's just a fact. The parent cannot take out that Stafford loan on behalf of their child. The rate of interest that their PLUS loan that they take out on behalf of the child is more than double that of what the child can pay. So, just think about that as a first step in kind of understanding who might bear the responsibility. Certainly in private products, the feature that we have in our private loans that's important is a cosigner release. So when someone takes out a private education loan, when there's a need for additional financing, we need to see the presence of a cosigner for our product. That helps us obviously understand the life cycle of repayment and likelihood of repayment. But we have the option for the student to take on that obligation themselves once their career has started and their earnings kick in. So that's something I would look for as well, to share that burden. Because it's real. Other strategies, again, are work study. Can you weave that into the equation? Can you do things like monthly payment plans together? And having that collaboration between the borrower and the parent, I think is what I've seen be the most successful. So it really is about both, if possible. And we know that's not possible for everyone, but that's what I've seen work best.
Shannon, when should a student or a parent consider co-signing their student? When does that come up, and when is it a good idea, and when is it not a good idea?
Yeah, so as we've talked about, the students can take the Stafford loans in their name alone, and there is no co-signer on a Stafford loan. But then if you want your child to take on more of the borrowing responsibility, and again, that's an individual family decision, a cosigner has to be involved. Again, at the very least, otherwise it's the parent borrowing on their own. Students in general, an 18-year-old kid with no job and no credit history cannot access funding beyond the Stafford loans without a cosigner. So parents would have to co-sign in that circumstance if they want their child to take on more of the debt burden. Otherwise, it's the parent taking on more of the debt burden. And I totally agree with Pete that this should be a shared responsibility, and every family is going to decide how that responsibility is going to be shared. I definitely think families need to think about how much burden they are putting on their child, in terms of, again, figure out what monthly payments are going to look like, and will your child be able to make those payments with their first job, starting salary out of school. That's one kind of guideline that you can think about when deciding how much you're going to borrow and who's going to borrow. One guideline that I think makes sense is you shouldn't borrow any more total for a student than your first year salary out of school is going to be. I think that's a nice, it's not going to work perfectly for everyone, but something to think about. If you're going to be making $30,000 right out of school, maybe you just want to stick with the Stafford loans where you can get $27,000 over 4 years. If you're going into a more higher paying career, maybe the student can afford to take on more of the debt burden. But again, the future isn't totally known. So maybe right now you think your child's going into a high paying career. Over the 4 years of college, majors tend to change. So again, you want to kind of be conservative, like Pete was saying. Make sure you're incorporating kind of a cushion into your thinking in terms of deciding when the student's going to borrow. Again, Stafford loans are the best deal out there. So the student, if you have to borrow at all, the student should be taking that Stafford loan. But beyond that, it's a family decision whether you want your child to be the primary borrower and you and the parent will co-sign, or if you as the parent want to be the primary borrower.
That's great advice. And I think that rule of thumb about trying not to borrow any more than your first year's salary is such a good sort of way to understand what is too much debt and what is maybe in the right sort of range for a student. So I'm going to direct this next question to Pete. And it is this: why is overborrowing problematic for parents? What are the risks? Why should they try to avoid it?
So, I'll take a step back and let's think about what we're borrowing for. So the first piece that you're borrowing for, non-negotiable: tuition, fees, and books. That's going to happen no matter where you're going. And that is, again, needs to be weighed at the initial decision of where to attend. That's different in many different places, but that's going to happen no matter where you attend school. The piece where we see people get into trouble and what we're real advocates for here at Common Bond out into the market is the additional piece that people are allowed to borrow in either the federal or private market, which is up to the cost of attendance. Cost of attendance then takes into account room and board. Room and board, again, is a personal decision full of personal choices. Where am I going to live? What am I going to spend money on while I'm at school? That is where we see overborrowing occur, when ultimately you are using borrowed funds for things that perhaps you can make a budget for and avoid spending. So that's the first place that we certainly observe overborrowing, and would encourage, again, in that plan that you're making together as a family, think about those choices. Because over 4 years, $1,000 less over the course of a year in rent, right, is less than $100 a month in total rent, but that's $4,000 that you'll borrow over the course of 4 years that'll bear interest, just that one decision, right? And so that's the first place to start for sure. Again, think and talk to your financial aid officers. They're there to help, right? They're a community that wants the best for the student, and they'll help you understand those choices as well. They'll help you understand if there's other funds at the state level or the institutional level that can really help that child out. And they're there and they want to have those conversations, and not every student takes them up on it. So that's the second place to start, is go use that resource that's part of your attendance at that college or university. They'll be glad to see you and happy to help.
Yeah, don't be afraid of the financial aid office. It's there to help you. So Shannon, a question for you, which is, I think, often misunderstood. Are your children required to help you repay the loans that you take on? Do they ever have to do that for you?
No, very short answer to that question. If you as a parent signed on the dotted line, you borrowed a PLUS loan, for example, that is in your name as a parent, the child has absolutely no responsibility over those loans. I've seen families sometimes have, informal arrangements where the parent is expecting the student to help pay back the loan, and the student may agree to that, but there's absolutely no legal force behind that agreement. If you're signing on the dotted line as a parent, you're the one that's responsible for that loan. So parents, have to be careful in terms of the debt that they take on, and again, banking on the kind of money that their child is going to make at some unknown time in the future. It's very tricky, and these sorts of big financial decisions can if you make the wrong decision, can cause lots of problems in families that you don't want to see. So you really do want to have those conversations up front. Make sure everyone understands exactly what their responsibility in this process is, what everyone is responsible for borrowing. Is the student responsible for working and earning some money that way? Are you as a parent expecting them to apply for scholarships to fill in some of the gap? You really want to have these conversations very early on. Certainly before you choose a school to enroll in, I recommend conversations much early in that, before the college process ever really starts talking about finances in general and these big financial decisions. It really has to be an open lines of communication in the family. I used to, when you talked about going to talk to your financial aid officer, that's what I did for many years. I worked as a financial aid officer. We love to talk to families. We love to talk to students. Too often I talk to parents who their child had no idea how much money they made. Their child had no idea why, paying $60,000 a year might be a problem. So you want to make sure you have those conversations up front. But again, a student is in no way legally obligated to pay back a parent's loan. So you want to understand that up front.
How early on should families sit down with their student to come up with a plan? And that's for Shannon.
I mean, families should be talking about finances from the child. I'm the child's, 5 years old and can start understanding money. But certainly once high school gets underway and students start thinking about where they might like to attend college, you want to start bringing finances into the conversation. And again, not necessarily excluding schools because they have a high sticker price, because financial aid is often available to supplement the family's resources. That very high price schools often don't actually cost the family that higher price, but start talking about what is realistic for the family, and having, a wide range of schools on the list, in terms of inexpensive schools, with more expensive schools where the student can get scholarship funding, perhaps safety schools where the student's going to look good and be recruited with scholarship funding. Those conversations should start happening early on in high school, I would say. And then by the time senior year rolls around, nothing is a surprise. And then there are some really deep conversations that will happen during senior year once admissions decisions come in and financial aid packages come in, and you're reviewing those packages and deciding what is or is not affordable for your family, running loan repayment calculators at that point to really figure out, is this particular school going to work for us, or do we have to look at some of these other choices?
Sure, that's great advice. And actually, Shannon, also to go back to you one more time, what kind of hints do parents have from the financial aid award letter about what they might be expected to take on? I mean, how can they look at it and kind of get a sense about whether this school is in line with what they had planned to maybe borrow or finance on their own? What can they look at?
So a tricky part is that there really isn't standardization across financial aid award letters. So you're looking at award letters from 5 different schools. They can look very different and have some different information. But what you want to do as a family when you're reviewing those award letters, make sure you understand each individual line item, that what's a grant, what's a loan. If it's grant or scholarship money, that's free money, that's good, that's what we want to see the most of. But what are the requirements for keeping that grant or scholarship? That's a tough thing that happens. And again, kind of an element of the unknown, where a child comes in with a great financial aid package, but maybe doesn't get the grades and loses a scholarship in future years. So you want to know what those requirements are. And then of course, for the loans, you want to know exactly what the terms are of those loans that they're offering you. So you just want to make sure that you understand every line item on the award letter, that you're not just looking at the bottom line, because sometimes some colleges do package award as financial aid, like a plus loan. That's not really financial aid, it's a financing option. So you want to make sure you're understanding that in particular when you're deciding what school is actually affordable or not.
We have a question from Facebook. So this question goes to Pete. Is it worth going to an expensive college, especially if it is ranked higher, for a family with an average earning?
Yeah, that's, again, first, a personal decision. But second, again, to echo what Shannon said, look at what that college or university offers in terms of average financial aid awarded. Because the sticker price and then what they offer in terms of grants and scholarships to the average student really then determines that extra bit that the family and the student is going to be asked to take on. Run calculators. College Navigator is a great site that I like to recommend to friends and family that shows you what that cost of attendance is going to be and then what the average aid is going to be, to give you that real cost that's going to be looked to the family to provide. We've got an undergraduate student loan calculator where somebody can take their award letter information at commonbond.co and see what that contribution is going to be after grants and the Stafford loan. And I would really encourage you to use that tool and any others that you find that are from reputable sources to really determine before you make that attendance decision, what are we going to be asked to pay and can we afford it?
So I'll kick this back to you, Pete. Should parents of graduate students ever be thinking about borrowing, or is this a different conversation for people who are going beyond the undergraduate degree?
Yep. So, in the graduate market, you can borrow up to the cost of attendance as a student. So the individual who is getting the education can fund their entire education through loans if they don't get grants and scholarships. What we see as well in the graduate market is there are lots of grants and scholarships available, and that's really, again, the legwork that's necessary prior to a parent getting involved in funding that graduate education. Now, if it's the right decision for the family, it's the right decision for the family, but ultimately at that point in time, and I'll give you my 2 cents, I think that person should be bearing the responsibility of ultimately achieving that degree that they're setting out to. And there's smart ways to do it without breaking the bank.
And one final question, and we'll kick it to both Shannon and Pete, but we'll start with Shannon, is this question often comes up with our audience is, when should a family take a Parent Plus loan over a private education loan?
Yeah, that's a great question. And there are pros and cons to both options. You certainly want to look at the interest rate. I would start there. What rate can you get on a private loan compared to the Plus loan? Again, right now, Plus loan is at 7% for everyone. In the private market, your interest rate is usually based upon your credit history. And it's the parent's credit history. Generally, they're the only ones with the credit history. So if you have excellent credit, you may be able to do better in terms of interest rate than the 7% on a Plus loan. So that's a big consideration, certainly. You do want to think about the protections, however, that a Plus loan does offer. Because it's a government loan, there are some protections kind of built in terms of deferment and forbearance options, cancellation in the event of death or permanent disability, which of course we don't want to think about, but it's a nice protection to have in your loan, which doesn't exist in most private loans. There may be some that offer that option. With the government loan, there's the possibility of loan forgiveness if you work in public service. There's some flexible repayment options. So you want to weigh those things. The Plus loan does have some nice protections, but you want to weigh those protections and the interest rate that it's charging against what kind of interest rate you could get in the private market.
Yeah, to echo Shannon's thoughts there, I oftentimes see people approach the student loan decision different than they would their car loan decision or a mortgage. And they're really similar, right? Look at the price you're paying. Get options. I would just encourage a parent that's faced with the choice between a Plus loan and private education loans to go out and see what kind of rates they could access given their credit history. They might be surprised at how much better that rate of interest could be in the private market. Most of the private lenders, and Common Bond certainly included, have brought our features up to near parity. We have full death and disability coverage, deferment and forbearance options that are very similar to what the government offers. And so it's really about looking at all of those options side by side and making the best decision for that parent and that student.
And with that, thank you, Shannon and Pete, for your advice on how parents should borrow for college without over leveraging themselves. If you're looking for more information on paying for college, you can visit us at usnews.com/paying for college, where you can find more information on funding college student loans, scholarships, and more.
And you can also head to money.usnews.com, where we recently published a 4-part series on parent loan borrowing. And don't forget to follow us too on Twitter and on Facebook. Thank you so much for watching.